anyone who's been in this metal play for a year or two, or at least 6 months, is probably sitting on some pretty healthy gains, right? So why do these markets crash? If you just got into it right now, you're probably wondering, why on earth are these markets crashing?
And then, which, in my opinion, it's not great, but you put these $2,000 gold bullions on there and they sell out.
While the dollar is back negative against its major peers, despite these comments from Scott Bessent yesterday, gold, copper and silver have all hit record highs. How much is that the debasement trade, and are the metals ripe for a nasty come down here?
Roughly a year ago, we argued that the silver market was sleepwalking into a silver squeeze. So in our view, we were always going to end up in this moment in time where what we were expecting was physical market constraints to result in significantly higher prices.
So, two questions there. One is, I think a chunk of this is definitely the debasement trade. I get a little bit nervous about that term, but it is valid to some extent. People are looking to diversify away from the US dollar. This is not about the end of the US dollar as the world's main reserve currency. It's just about they've been massively overexposed and they're looking to reduce that exposure.
Okay, I've got to admit it. This is what a real market shakeout crash looks like. Silver down 34%, gold down 11%, platinum down 16%, palladium down 17%, copper down 5% in hours, sometimes in minutes. And, suddenly everyone's confidence is evaporating and disappearing, and some might say rightly so. The same people who were screaming structural shortage, structural deficits, headwinds, tailwinds 3 months ago are now asking everyone what has actually changed. Nothing changed. Nothing has changed. The narrative hasn't changed. Nothing's changed. The price has moved. The narrative has not. And if you don't understand that distinction, this is where people are going to permanently lose money. They're going to close out quickly. The weak hands are going to close out. They're not going to ride this macro narrative that has so much catalytic energy in it. They're going to permanently lose money and be shaken out. Because crashes, they don't destroy long-term theses. They test conviction and they transfer the assets between the long-term holders and the weak hands in the speculation market. And every major metals cycle ends in the exact same way if you do all of the analysis. Weak hands, they sell the fear. Strong hands, they reposition quietly. So let's slow this down a bit. Let's talk about this gargantuan crash. Let's call it what it is. It's a crash. And let's name the mechanism. Silver crashed, gold crashed, the metals crashed. Why did it happen? What happened? It's not just a demand collapse. This was not a technological breakthrough the metals made irrelevant or some new paradigm that we're now living in. This was not the end of monetary debasement or electrification or decarbonisation. Even Kevin Walsh was not the reason the new Federal Reserve nominee. He's not even the reason why this happened. This was a positioning unwind after a violent multi-month, multi-year run-up. Markets do this every single time after really large gains. There's nothing to really be worried about unless you're completely, irresponsibly and recklessly leveraged. Silver doesn't fall 34% because the world stopped needed it. That's not how it works. Gold doesn't fall 11% because governments started exhibiting fiscal discipline. And copper doesn't drop because data centers have been cancelled. They fall because too much leverage has been built up in the system on that side of the boat. And when the liquidity tightens, and it always does, even temporarily, the market clears that leverage out absolutely brutally. This wasn't a fundamental event. This was a liquidity event. Always is. And liquidity events always feel like the end of the rally, the end of the narrative, the end of the paradigm. Right before, of course, they aren't anymore.
What's actually driving things now is that we have transitioned away from a physical shortage to a liquidity shortage. And this is largely a function of the imminence of the Section 232 critical minerals investigation, which silver is now a part of, which has constrained the arbitrage that almost guarantees liquidity in precious metals markets and silver markets in this case.
Metal crashes are a feature. They're not a bug. Let's state this clearly. Violent pullbacks are normal in metals. They always have been and they always will be. Why? Because metals are macro narrative collisions. They are where the stories of geopolitics, of supply and demand all meet and coalesce around one point. It's always the stories of inflation versus real rates, growth versus slowdown dynamics, liquidity versus tightening, monetary debasement versus the confidence of the day, right? Or the lack thereof. And when the metals rally, they rally hard. I'm talking about like 5x's, 3x's, sometimes even 8x. When they correct even faster. But it's never the signal that it's the end of the trade. It doesn't invalidate the trade, it just resets it temporarily. And to be honest, every major macro bull market, every cyclical secular bull market needs to have that healthy reset. Every major bull market in the metals has had 30 to 40% corrections on the way. Silver had it, went up 2x in the following quarters. Gold had it, went up 3x in the following quarters and years. And every time, the exact same thing happens. People confuse volatility with failure. But if the reason you owned metals was currency debasement, sovereign debt expansion, irresponsibility of our institutions, structural electrification, AI infrastructure demand, assets being frozen, people switching out their structural treasury accounts from just being dollar-based to being hard metal-based, then ask yourself one question. Which of those one things has actually reversed? None of them. Nothing's changed, the narrative hasn't changed, the price has changed. Because I don't see governments running surpluses. I don't see governments acting responsibly all of a sudden. I don't see AI build-outs slowing all of a sudden. I don't see data centers shutting all of a sudden. I don't see central banks finally discovering come to Jesus moments and discovering discipline. Because monetary metals, nothing has changed when we think of it as a feasible investment thesis. It's all the same. In some ways, it's even getting worse.
This is not about the end of the US dollar as the world's main reserve currency. It's just about they've been massively overexposed and they're looking to reduce that exposure. Now, there are the other major fiat currencies out there aren't looking particularly attractive. In the mid-2000s, when we went through a phase of trying to diversify away from the dollar, we were getting very excited by the euro, which was kind of fresh and new and looked like it was really uniting well. We were getting excited by the yuan, which had joined the WTO. The Chinese market was booming. Its assets were booming. And we even were much more positive about the yen. We didn't realize it was still in the early stages of 3 decades of stagnation. So I think there were many exciting options back then, and we really got excited about emerging markets. It was the rise of BRIC. Today, people having been burned on these kind of narratives before are not as excited by the counter narrative.
Markets were a bit perturbed or surprised that Kevin Walsh was actually elected. But ask yourself this. Every responsible central banker eventually faces the exact same reality, and Kevin Walsh is going to be no different. You can't run a debt-based system without debt, without liquidity. Markets are already going to be pricing this in. Financial conditions are going to be tightening, something's going to break, and suddenly QE is rebanded as stability operations or liquidity facilities. Do you really think Donald Trump is going to have elected someone who is antithetical to his desire to lower rates? Of course not. It's going to be the same printing, it's going to be different language. It's going to be an obsequious person in the Federal Reserve who's going to do the bidding of Donald Trump. What does that mean? The narrative hasn't changed, it's just got even better, even more bullish for the monetary metals. Metals don't care about the language, they care about the balance sheet. And the balance sheet is going to be growing under Kevin Walsh, irrespective of what he said before. That's how he got elected, and that's how he's going to run the Federal Reserve. We all know that it's not just him running the Federal Reserve, there's a panel. So let's just not put all of the eggs in one basket with him. But that's the direction, that's the trend. Funding the debt, monetizing the debt, bullish for gold. Let's talk about the industrial metals, copper, platinum, palladium. This is where people are making the biggest mistake, thinking that this huge sell-off is actually a material change of narrative for them. AI is not software. AI is infrastructure. AI is hard assets. AI is hardware. AI is raw materials. It's data centers, transmission lines, cooling systems, HVACs, backup power, electrification at huge scale. Copper is not optional in that build-out. Neither are the platinum group metals, the PGMs, palladiums and platinums. And here's the key point. AI demand is additive. It's not substitutive. It just gets more and more and more. It demands more and more and more metals. It stacks on top electrification, EVs, grid upgrades, industrial reshoring, HVACs, cooling system, memory systems. It all adds on top of everything else. So when copper actually drops 5%, that's not a warning sign. That's not something to be worried about. Oh, the macro thesis is dead. It's over. That's a liquidity pause in structurally tight markets. You have to look at my previous videos to actually appreciate how badly supplied the copper market actually is. The supply didn't surge. The mines didn't just appear one day out of nowhere. Permitting didn't accelerate. Tier 1 mines haven't been discovered. Demand has just taken a breath. Anyone who's been in this metal play for a year or two, or at least 6 months, is probably sitting on some pretty healthy gains, right? So why do these markets crash? If you just got into it right now, you're probably wondering, why on earth are these markets crashing? Start with the big boys, the real monetary metals, gold and silver. Gold exists for one reason: to price the credibility and the risk, the counterparty risk of governments. The credibility of governments and institutions is not improving. It's getting worse. They're not managing money all of a sudden more efficaciously or effectively. Debt levels are higher than ever. That's still the same story. Deficits are structural and growing. That's still the same story. Trade balances are growing, and in terms of deficits, they're growing even more. Things are being funded by an ever-increasing amount of M2 mining supply. That hasn't changed. Silver sits in a dual role, though: monetary metal and industrial input. That makes it volatile, that makes it explosive, that gives it a different dynamic and input variable to gold. And here's the uncomfortable truth about all of that. Gold and silver don't crash because the system is healthy. They crash because the system tightens briefly. It panics and then it prints again. It prints over again, ad infinitum. That's why the long-term trend of these monetary metals is always up, and it's tightly correlated and linked with the devaluation of the currency and the debasement. Which brings me to the absolute huge monolithic elephant in the room. QE isn't dead, it's just loading. It's in a holding pattern above some target where it's going to drop an ungodly amount of monetary methadone onto a bomb site. Everyone keeps pretending that quantitative easing is gone forever. Everyone keeps pretending that governments have finally discovered fiscal disciplines, that prudence and good saving and good management is actually there organizationally. But QE never dies. It only hibernates because the debt load mathematically requires it. The debt hasn't changed. The deficit hasn't changed. It's all the same. And now you have a new Federal Reserve governor nominee, Kevin Walsh, who many assume will be hawkish. But let's actually look a bit closer about that.
They're like, we can increase exposure to some of these other currencies, but they're not, they're not great alternatives, which is why they're piling into real assets. They're basically worried by the fiat currency idea, which is where we got the debasement trade idea. So they're looking for real assets, and precious metals are both, benefit from being a kind of a real asset, but also by that idea that they are haven assets. They benefit from uncertainty, from risk aversion. They've got a historical record of being sometimes stepping in as currencies. So absolutely what's happening in metals is about that. You ask whether they're ripe for a drop. The rallies of the last couple of months have been truly extraordinary, particularly in silver, more so than gold. But you could have said they looked ripe for a collapse at any point since December, and they've got another 30-40% since then. Sorry, more than that, apologies, because I think silver's actually up about 60% year to date. The moves are happening so fast I can't keep track. So I think that, they look really overextended, but you know what? The people who have lost money here have been the people trying to pick the tops. I think we're in a frothy end game. That does not mean you start shorting it today.
Let me leave you with this, because I know this is a bloody scary moment right now for everyone, including myself. When I woke up and I saw my trading terminal, I was perturbed, to put it lightly. People love narratives, though, until price tests them. Metals don't fail. They didn't fail. They won't fail. The leverage did. The sentiment did. The positioning did. The timing did. The monetary system is still very, very fragile. Debt is still expanding. QE is still inevitable. AI still needs the metal. The crash didn't end that story. Governments haven't found this new way of life, or this new approach to monetary debasement, or this new approach to QE and quantitative easing and providing liquidity. It didn't end the story. It just advanced that one chapter. And history is always very clear about what happens next. So yes, this is a very, very scary moment. But if you're positioned correctly, if the tea leaves haven't changed, if the thesis is still the same, if the macro narrative still exists in the same paradigm, in the same situation as it did before, there's nothing to actually worry about. So let's use this moment as an opportunity to leverage down and to add into already winning positions. And then catch us on the other side, a few miles down the line, when we can zoom out and tell our grandchildren about this truly epoch-defining trading moment. Ciao for now.